On Tuesday, June 23rd, spot gold prices staged a dramatic high-altitude reversal. After flirting with the critical $4,200 psychological barrier in early trading, peaking at $4.198 per ounce, the precious metals faced aggressive institutional liquidations, plummeting sharply and even briefly cracking below the $4,100 mark intraday. Spot gold ultimately closed the session down a staggering $81.42, or 1.94%, at $4.110.22 per ounce, completely erasing all of the previous day's gains, despite encouraging progress in the U.S.-Iran peace talks and Washington's announcement of a temporary 60-day sanctions relief for Iran starting Monday. The de-escalation of geopolitical tensions in the Middle East failed to salvage gold prices. Market strategists at StoneX noted that precious metals have completely decoupled from geopolitical developments, with investors firmly locked onto the Federal Reserve's aggressive rhetoric from last week. Rate hike bets triggered by the newly appointed Fed Chair, Kevin Warsh, continue to gain traction, with money markets now pricing in an 86% probability of a December interest rate hike. This hawkish momentum propelled the U.S. dollar index DXY up 0.40% to 101.39 on Tuesday, marking a fresh year-to-date high. Simultaneously, the policy-sensitive 2-year U.S. Treasury yield climbed to 4.19%, further compounding gold's misery. The June S&P Global Manufacturing PMI unexpectedly climbed to 55.7, up from May's 55.1. Robust economic data has reinforced the Federal Reserve's higher-for-longer policy stance, delivering a devastating blow to non-yielding bullion, with gold and silver bulls currently retreating to defensive lines in the sand. Market participants are on high alert for heightened short-term volatility. Investors are now bracing for Thursday's crucial macro data dump, which includes the U.S. Core Personal Consumption Expenditures (PCE) Price Index, the Federal Reserve's preferred inflation gauge, alongside first-quarter GDP revisions and initial jobless claims. These data points will provide decisive cues for the central bank's monetary policy trajectory heading into the second half of the year. This content is for reference only and does not constitute investment advice. Trade at your own risk.